Welcome, big welcome. M. Sullivan here, your mortgage accountant, auditor, offering over 30 years of secondary markets experience. Glad you could join us. Today's presentation is a good one. You didn't pay your taxes. Can't state a claim if you don't pay your taxes. We're talking about concealed timing and valuation for withholding taxes due on canceled debt. Cancellation of debt by involuntary conversion into income. You should know that by now. The mortgage canceled, not pay your tax. So glad you could join us. I think you're going to take something away from this presentation that's especially important that may have not been made clear at other presentations. Just a reminder, we're not attorneys. Only an attorney can represent your legal rights in property. And of course, special thanks to corporate music. No copyrights intended or claimed. Let's get going. So today we're looking at the evidence or the discovery that we are finding consistently in files. And the proof is in the statements, as you can see. The statements I'm referring to are the monthly mortgage statements and a payoff demand, which are essential to your discovery. I've emphasized this in most every one of these presentations. We're looking for a monthly statement and a payoff demand to give substance to the discovery that we believe will be sufficient to set aside the case or to have your attorney make a good argument on why the foreclosure is being brought under a set of unlawful or unethical and unlawful criteria. So what we're trying to emphasize here that borrowers are converted from a mortgagor to a payee. Okay, that's right. Borrowers are converted from a mortgagor to a payee, and servicers are converted into paying agents. Servicers are not servicing mortgages. The mortgage was canceled, so they become paying agents. The payee receives the 1099 from the paying agent at the end of the term or after the foreclosure sale, the year after the foreclosure sale. So the lender successors are its creditors or the loan's purchaser. That's the one who's behind this scheme. And what's happening here is the borrower is made the party who is repurchasing the file that never sold as a whole loan investor. You are a whole loan investor. You're asking where the money come from for the 1099. That money was credited right back to either one of these parties, the lender successor as a creditor or as the purchaser. And that was to allow you to purchase back the file, phantom income that will be realized at the end of the disposition, which they're calling a foreclosure sale. I want you to pay your taxes. So what we're talking about is a mortgage that was canceled. If the mortgage is canceled, there's no terms and conditions left to enforce on the instrument. The instrument has to be extinguished. The debt was extinguished. The instrument's extinguished. That begs the question of what's happening with the security. The security was also extinguished, and it was used in order to exchange or transfer title. Your title transferred to a third party in trust to an indenture as a trustee. In our analysis, we're looking at the actual dates and values taken from a current file and judicial foreclosure case, and this is what's really compelling to show that there's means and methods used to the cancellation of debt, which I call a big tax loophole that's taken advantage of the American public, the middle and upper middle class public, general public. In this case, what I'm looking at are the event dates. We have the date the loan closed, the date of the last payment, the foreclosure date that was filed, and the scheduled sale. These are all dates that were provided to us. We didn't have to guess. We didn't have to make any of this up. These are dates that were provided to us. And on each of those dates, you can see there was a value, 586.3, 618.05, 781.631, and 881.650. What we're looking at are the margins between each one of these event and valuations. Each event, that's your timing, each amount, your valuations. The difference between these two was 31,705.81. You can see the difference between these two right there. And the difference between the last two numbers, 100,018.91. When you add these margins up, we come up with 295, 350, 53. What's interesting is coders and programmers who designed this behemoth mess, this AI technology, whoever designed this was given specific instructions to meet the threshold or the requirement for federal withholding. In this case, it was 33.5% on the mark. Come on. Not 33.549 or 33.498, 33.5% on the mark. 881,650, your scheduled sale value, multiplied times a federal tax withholding rate of 33.5% equals, got it, 295, 350, 53. Is there any question here, any doubt about what we're talking about? the federal withholding tax on the cancellation of debt valued at $881,650 is $295,350, and that was earned out over a period of time by each event. That tells me that Uncle Sam's foreclosing on you, folks. Banks may not be the bad boy you think they are. You got Uncle Sam behind it. I like this one too. I need corporations to pay what they owe the working people and to our country. I don't know if I subscribe to that, but I thought that was kind of cute. Anyway, that's our analysis. Let's keep moving on. I heard somebody out there say, I need more, Mr. Solomon. I need more. Well, we'll give you more. We got plenty to go, plenty to give, and plenty to provide. We're talking about who is paying the tax on that property that was transferred for the income that was paid to you as consideration for the exchange. Got that? I hope you do, because I can't repeat that. Each case we've looked at and audited. I'm telling you, each case leads us back to the IRS for federal withholding taxes due on COD income. Boy, if this is true, which I believe it is, banks are taking a hell of a beating as far as their reputation goes for the expense of the IRS. But what we had here was the margins. The margins totaled $295, $350, $53. Federal withholding rate of 33.5%, capitalized at $881, $650, $53. That was the scheduled sale value. Now, check this out. If we take the rate, and this is where it gets tricky, if you take the rate 3.5%, which seems to be a weighted average rate, the 3.5% I picked up from a mortgage servicing statement as the last rate, that 3.5% goes into 33.5%, 9.57 times. That's your number of installments, annual payment. So if I'm going to divide that by 9.57, I'm going to divide my margins by 9.57. It gave me 3857.77. 38,577 capitalized at 3.5% came out to 92,113, and that equals 9.57 installments. As you can see, this is the valuation side of it. This was the income. The valuation is what accrues or is what's being paid down from the income being paid to you. This is paid to you. This is what's accumulating based on a cap rate. 9.57 installment or years at 365.25. That gave me 34, just under 34.96 days. That's the term. Now, if we take the date of the last payment made, late payment would have been 2/15/10. I take that out, that number of days, it takes me to, there's your 9/11 again, 9/11/19. Department of Treasury says tied out by 7. 9/18/19 is what I'm coming up with, and survey says, yes, the sale was scheduled and published on 9/18/19. Folks, is there any question here? Any question about what's going on and who's foreclosing on you? I don't think so. So let's do a little recap here and make sure we're all on the same page. What is COD income? When a lender forgives partner all of a debt, it results in COD income, cancellation of debt income. The general federal income tax rule is that COD income counts as taxable gross income. For the year when the COD income occurs, a lender is supposed to report the forgiven amount to the borrower and the IRS on Form 1099-C, cancellation of debt. Form 1099-A, though, acquisition and abandonment of secured property. Form 1099-A, acquisition and abandonment of secured property, is a federal tax form filed by lenders to report properties transferred due to foreclosure. What does that say? Acquisition and abandonment of secured property. That doesn't say mortgage. So secured property is a federal tax form, filed, the 1099, filed by lenders to report properties transferred due to foreclosure. Could that be exchange of shares for title, equitable shares in exchange for the title? Title was valued as a corpus that was used as paid-in capital. You got the right to ask these questions, folks, and you're not. Discovery, the Internal Revenue Service, IRS, requires lenders to file in the year following the calendar year in which the taxpayer acquires an interest in the property or first knows or has reason to know it has been abandoned. Did you abandon your property? Did you abandon your claim? Was that claim a right of reversion? Did you fail to state you were the right of reversion? Did you cry out fraud, and for that reason it was construed as an abandonment by the court? Caution. The issuers of the 1099 must include details about the sale, including the date of transfer and property's fair market value. That has to be brought up into a court. You have to request that. That's got to be part of your discovery. They have to answer it. This falls under the jurisdiction of the Internal Revenue Service. So what exactly are we talking about? We're talking about getting off the fraud. Let it go. There's nothing about attacking a lender, nothing about attacking lender standing. This is about reading the file correctly and stating a claim for reversion. You are the reversionary interest, where the seller is a nominee and you buy back the home they're placing into foreclosure. You're acquiring it under 1099A, so don't abandon it. Do you get that? 1099A, acquiring it. Don't abandon it. 1099A. What I'm trying to emphasize here is all real estate sales and transfers must be reported to the IRS. These are the IRS, straight from the IRS. Form 1099A is typically used to report the transfer of a foreclosure or abandoned property. Which one is it? Lenders must submit a copy of Form 1099A to the IRS and another to the borrower. Taxpayer reporting information from Form 1099A on Schedule D. You report it on Schedule D of your tax return as a capital gain. The IRS treats capital gains from foreclosure the same as a traditional sale. The property was sold to you, and you need to pay the tax, or someone's going to pay it for you. Do you get it? To wrap up, we're talking about paying your taxes and claiming title back. We're auditors and accountants. Again, background, 30 years, secondary markets. Send us your statement, recent monthly mortgage statement. Request and send us a payoff statement. Have to have a payoff statement. Let us see those forms. Include a tax form 1099 if you have it. There's no charge to review your file. If you want to engage us after we show you our discovery, if there's any discovery, then we can talk about that. But right now, all I need is a monthly statement and the payoff statement, which you're entitled to, as well as a 1099, should you've received one before the foreclosure. If this is a foreclosure that already took place, then definitely include the 1099. And there you go. I want to thank you for joining us. I'm M. Solomon. You can reach me again at 202-270-2641, 202-270-2641, offices in Washington and Nevada. And you can also reach me and contact me or send me the information, scan it, secondary trade desk, just like it sounds, secondary trade desk at gmail.com. We are auditors and accountants. We are not attorneys. Only an attorney can provide you with your legal advice and legal rights and property. Thank you so much for joining us, and look forward to hearing from you. Leave a comment.